All right. Good morning, everybody. So it turns out I'll very likely be here Friday. Have to put the plans on hold, but I will be gone on Wednesday of next week. So there won't be a morning briefing Wednesday next week. Small caps up the most. Europe down the most. There's a lot of software getting hit today. HP, HPQ. It's a list. The list includes, and the reason it matters is if we swap from IGV to, say, back to chips, then it's going to be a play off of that. So Autodesk, CrowdStrike, Dell, HP, Workday, all of those got whacked. And that's not even the full list, but that's a really good start. So software and hardware taking a hit. Dollar is reacting to the potential of a ceasefire leading into some sort of peace. Should see reactions in gold from that, precious metals, silver. We have an absolute full house today when it comes to watching the clock, but most of it is done by 10 a.m. 10:30, although it's not on this list, we also have the EIA report. So we're going to get some crude oil inventories. There was talk about refilling the strategic petroleum reserve, but I was under the impression that we were pretty close to full already. So I'm going to have to dig a little deeper into that, but we'll get some numbers anyways at 10:30, and that'll give us a better idea what's going on with inventories. And we have auctions today. With the tariffs and everything else happening, keep your eye tonight on Japan bond investment. It's just going to keep coming at us all day. It's going to be one of those sort of days. So don't get complacent. It's absolutely possible that we pick a narrative or we pick a theme today and that it sticks all day. But with these sorts of events lining up the way they are, the narrative can change with each new data set that comes in. We do have a market maker move this morning also, and that's got to be taken into consideration from the hedging that it implies. So they're worried. They're worried, they're hedging. So we got to be worried. We got to watch for their hedging. Now, it's not my opinion that they're hedging. Hedging happens all the time. They do it constantly. So this is a little above and beyond some extra protection. And if they're worried enough to spend the money for extra protection, we need to be worried about whatever it is they're worried about. We want to keep our eye on that market maker move to see at what point it starts to fade back. Do you mind? If you don't have the market maker move label, you can keep your eye on the market maker move up here. And if you're not on Thinkorswim, then just look at options in the front end. which is the 0 day, against options for the next day out. If the front number is higher than the next number out, you have a market maker move. You can kind of do that math. Your number on your own likely won't be the same as that market maker move number, but you can do the math on your own. Whatever number you get, you should see it decrease after whatever event it is has passed. And the reason I say that is we have a lot of events today. It's very likely the 8:30 event. But if it's not, we won't see that market maker move begin to decline until after 10 when we get the next group of events. If you haven't heard it before, we're looking for one of these really big candles. So at 8:30 and at 10 o'clock, we have the opportunity to get this. This is what I call a liquidity gap. You can call it unfinished business if that helps. The whole idea is we left so quick, so fast that there's a lot of unfinished business. But another way to think of it is there's a gap in liquidity. So when we get this sort of gap, we look for the gap to get closed. It means price has to go back to where it started when the event happened. Here's an 8:30 print, drop to the downside. Notice there's no real wick on the back end here. And we closed near the end of the candle. Got back there about 11 o'clock. This is an upside move. CPI, same thing. No real wick going in the opposite direction. Closed in the upper portion. Continued the drive. Built a base. Came back to where we started. With so many events today on the table, we're going to very likely see these sort of moves intraday. So if it looks like this, I don't want to play it. And that's not to say that this candle doesn't have any value. It does. We can measure the candle from its highest to its lowest point, project that up 50%. That's where we stalled out. So we can use it even if we don't necessarily want to trade it. And that goes for the good, clean, solid candle or a wicky candle, whatever we get. Right? So we can mark the half back, see price, test that. We can project the 111, the 1236, and we can project 50% also. So obviously I got a lot of examples here. Even if you don't want to trade this, just keeping in mind that there is such a thing as a liquidity gap, that price is going to want to behave this way, should provide a little bit of pause so that you don't see one of these big moves and think, oh, we're going bullish for the rest of the day because we had a big bullish candle. You know, if you had tried that, that wouldn't have worked. Or a big bearish candle and thinking we're going to go short all day because we had a big bearish candle. Now, even though I've got all these examples where price went the other way, there are examples where we get a really big candle and then price just keeps on going in the same direction and it doesn't come close the gap. So this is not guaranteed. You want to see that it starts to build a base, that it starts to signal it's going to turn, and even measure that candle from its highest to its lowest point, project above, you know, the 111, the 1236, the 1.5, even project that to the downside, because it's very likely if we break outside of the range of that initial candle that we're going to reach those targets and respond there, whether we flip or stall, whatever. So we can see the volume is light, it's at 75, and we can see the market maker move tag. They're waiting on one of these events today. We certainly have a lot to choose from. With nat gas moving as much as we've seen it in the last 6 weeks, that's another one worth paying attention to. That's at noon today, right? We're going to get oil and gas both. Normally we'd get gas on Thursday and crude on Wednesday, but you know, with the holiday, they're just piling everything in together. The put wall was rolled down yesterday, 55.19. That's not usually a good sign. It doesn't mean we're going down. We've seen them roll it down and then bring it right back up again. Just remember that the put wall is like it's an automatic feature, right? The algo just looks at the gex and does the calculations and says there's the put wall. But if you've read spot gamma enough, you'll notice where they'll point out and say, yeah, technically this is, you know, the put wall, but it's not a good one. It's a fake put wall. So the fact that it's been rolled down, I don't like it. It's not a good signal, but unless it stays there, then I would say it's very likely a fake put wall or a fake move, and that we'll see things change anyways. We are getting close to the end of the expiration cycle for the ES, NASDAQ, that whole group. We've got 23 days left, and we generally will roll a week or so before the calendar date, right? So the third week of December is OPEX, and it's likely going to be a triple witch. You're going to want to be done with that contract probably between the 6th and the 9th, right? So by the time you come in Monday morning on the 9th, Thinkorswim will probably already have rolled TradingView. So if you're on a manual roll like Trade of 8, Ninja Trader, you're going to have to do it yourself. If you're going to do it manually, just keep track of the volume on the front one, which is the December series, and then the next one out, which is March. If that volume in March gets greater than the volume for December, manually roll to the next contract. So far, the week has that classic D shape. We've been holding things really tight. This is the first day of low volume, which we're attributing to all of the economic stuff that's on the table today. But the thing is, they're already calling for really light volume into the rest of the week. So on Friday, for an example, it's not expected to be any better. Low volumes in a high tension, high environment that we're in currently means we could get some fantastic moves, right? Just face rippers because of a lack of liquidity. So keep that in mind. A lot of times these distributions lead to a breakout or a breakdown. $59.20 to the downside still looks good. And these 2 points of control from 2 weeks ago and our current point of control, I mean, they're just lined up really nice, right? So we dipped down, ran right back up into the point of control, and we're just stuck there again, building it out. So we got a really wide channel today on the floor pivots. You can see how yesterday's narrow channel compares to today's. A wide channel implies that if we break out, we shouldn't go anywhere. Just remember that these channels don't make price do anything. And after holding sideways for 2 days, markets can get bored, complacent, and we can make a big move just because. On the other side of that argument, the longer we stay sideways, the more and more we get boxed in. There'll be liquidity on each side, and we'll find it harder and harder to get through that liquidity. like rails at the bowling alley. Today's floor pivot is higher than yesterday's. That's considered bullish. So far today, we have an MDP. That's a missed daily pivot, but we can't count it because it's today, right? We can only count that missed daily pivot after the day ends. Markets generally hit their pivot point 80% of the time. So, there's an 80% chance that we're going to go down here and hit that line just because we haven't hit it yet. Keep in mind that pivot points, measured moves, all of that stuff, nothing stands in the face of an economic event, right? So you got something on the books, the news hits, it won't matter what's in the way. Moving averages, yesterday's high, low close. When the news comes out, market's going to move and there's just nothing that's going to stop it. If you look at this week's anchor, which is this purple line right here, it's 60.17. So a break to the downside will also put us in contact with the week's anchored VWAP. The average daily range right now is 1.13. I think a month ago it was 0.93. So it's increased quite a bit. We don't have any edge at this point. If we were close to one side, we'd say we'd just go ahead and hit it. But I mean, we're kind of flat. So we don't have a lot of edge towards one side or the other. Got to get through the ADR to get anywhere else. And if you consider it from, say, if we're looking at yesterday's range, well, Monday's range. Monday set the tone. We tried to break out of it Monday night into Tuesday morning. We tried yesterday on the other side. So those are just tests that begin to widen out like the megaphone pattern. If we wanted to break through the low, we'd have to get through the ADR half and then the low and then the full ADR. But if we want to break out of the top side, the ADR half is a long ways off. So we have less resistance to the upside. That's not to say that we're going to go up just because there's less resistance up there. It's just that there's less resistance there, less to fight through. That is the range, by the way, that we have to deal with Monday. Simple enough to just go out to the daily chart, mark Monday from high to low, stretch it across. We can break that level. We can wick outside of it. We can close outside of it. But as long as we're still within the 1, 2, 3, 6 of it, then we can just come right back in again. Something like that, right? Just add that 1, 2, 3, 6, the 111. That's the level we got to get through, right? 6011 cog line is the midpoint. So just getting through that 111 is going to be work. But once we do, then it's a good shot down to 59.92 cog line. Got the roundy down here. Then the 111 and the 1236. That rising wedge yesterday really didn't break all that well either. You know, we got maybe 30%, 40% of that rising wedge, and then it just came right back up again. So you can get blow off tops on a rising wedge, and it looked like we were going to get that. Then we built this kind of crooked head and shoulders up here. And of course, you know, head and shoulders are like the butt of all pattern jokes. You know, it's not your high end trading pattern. So if the only thing we have is a head and shoulders pattern, that's not a very good one. Plus, measuring it, it's already made its anticipated move, so it's done anyways. Now we could focus on something like a intraday failed flag play, which has already started to break. But with all the economic data on the table today, that's going to take precedence anyways. So the failed flag play would be the idea that here's the flag pull. The flag is still valid as long as we're underneath the 786, and we would continue to the downside with a bearish flag. We say that it's a failed flag if it gets above the 786 and begins working towards the half, because then it just turns into a cup, and maybe we get a handle, maybe not. Failed flag. But we still have to worry about all of the data on the table this morning. We've got another day and a half of candles to wipe out here on the left. For every candle that we get on the right, we're going to take one of those away on the left. But we're building it out again, and it doesn't look like we're going to see a shift down to this 59.22 after all. It really just was dependent on whether or not we would stay in this range or this zone. And as long as we're just hovering here back and forth, then it's a more of a magnet and less of a support and resistance area. Got a new VPOC from yesterday. So just take one of these lines. Looks like 60.18 and a half or 60.18 and 3 ticks. So a cut to the downside, we've got to take that point of control into consideration. $60.65, the upper edge of the weekly expected move. We got to get there first, but that does become a target if we get an inside breakout of yesterday's high. That would be a really good goal, that 60.65. Now, if you go back and look at the weekly expected move, there's a lot of examples where we've reached the edge of the other side in a single day. Even just going from the midpoint to the edge in a single day would be bad enough, right? And we've got plenty of examples of that. But to go from the green to the red in one day, it's absolutely doable. So breaking down back inside of yesterday's range, if we break out of it and then come back in, that would be a good target. 59.91 cog line and then 59.11 cog line, which would get us to the red and overshoot us. I know it seems like a lot, but it's the velocity of the move that we're looking for in this low volume environment, right? Not just, oh yeah, we'll go down, but one of those face ripping high velocity moves on low volume, one time framing, right? Just printing hard to the downside. Could make for some cheap lottos once the day gets started. We are 2.5% above the 10-week. It's a good place to be. We can see the curve continues to the upside. Nothing wrong with it. We're not overbought. We're not overextended. It doesn't owe us anything. It's fine. And on the daily, we're not even 1% away, right? So when it comes to the 10-day and the 10-week, if we just stay still, the 10 will come to us, right? So that's a correction in time. So when we need a correction, we can move down or move up and get to that 10, or we can just hold tight and let the 10 come to us. We had the curve where we came down, we got the correction, we ran back up, and now we're starting to roll over again. That's the wave, right? It's just what we do. This doesn't mean that we have to go back to the 10 and tag it. There's plenty of examples where we've pulled back and we didn't get to the 10. The correction isn't perfection, right? We're not owed that tag. So we got semiconductors down, nat gas, and software, expanded tech, but not down enough. We would want cloud computing, IGV, we want those down at least 0.5% to meet our benchmark. But SMH or the chips, they're down more than 0.5%. On the other side, we've got the China group, the China ADRs through the KWeb. It was down 7% over the last 5 days. So we're up 3 this morning, but we're still down 4 over that 5-day period. This is more of a relief bounce than anything else. Got Bitcoin making a little bit of a relief bounce as well. And it's odd, to say the least, that they're almost in sync. They were both down 7%. They have both bounced this morning 3%, and they're still down over a 4% in a 5-day period. It goes back to the argument that that high correlation with risk. So it's worth keeping an eye on the Bitcoin plays today. Hood, Mara, Hut, MSTR, Hive, Riot. Because if we're getting some run in Bitcoin, and if the indexes do want to stay sideways, then at least you got something. Gold miners, banks, bonds, home builders, moving in the right direction. Uranium and bonds not quite up enough yet to meet the benchmark, but they're moving in the right direction. And pot stocks down. There was some pot stocks news about December 2nd having some kind of legislative adjustment from changing their schedule, drug schedule. You would think that would have gave us a little bump to the upside, but nope. And solar is down, which is odd because solar should be playing with the China group. And if China's got a little bump to the upside this morning, well, I'd expect that this would too. So, you know, a lot of these platforms, they'll use the after hours and they'll use the pre-market data. And that's what it looks like they're doing with solar here. We don't really have any pre-market. We just have that after hours move with the dump. So I'd expect solar names to get a little lift this morning, especially if like, what was the one good name? Was it like Freeport Mason this morning? I mean, that it's not solar, but that was like the one good name out of all the software names that were getting hit. Keep your eye on solar. Could see a play on that, even though it shows that it's down this morning. Yeah, all the Bitcoin's stuff, Bitcoin proxies are up. And a lot of those chip names, like NVIDIA is tied in with Bitcoin, PayPal. And bonds are likely still not a good play yet. We got this really wide base down here that's just getting started. If you was to snap the fibs like we were doing earlier, it would line you up with a 786, but I just don't think it's going to offer the same sort of outcome. So you can drew it from this way, maybe adjust it, hit it there. Yeah, that looks a little more accurate. So we still have this blue line. That's the anchored VWAP for the year. We got to get through this 93 on TLT if we're going to make the move up. And then we've got that anchored VWAP. If we can get through that, then we've got the half, call it 96. We're getting a little bit of a curve on the MACD. So we're starting, right? But I don't think it's going to be a smooth shot until we get back above that anchor. All right, guys, that's what I've got. Look, be careful today. There's a lot of data that's going to be coming in. And with the low volume, it won't take much to really make this market move. Stick with themes or groups or sectors, industries. I think that'll be the easiest way to monitor what's going on today. Something like an ADR or that advanced decline, something with some money flow in it, so you can see the ebb and flow of what's going on and just play with the group. I think if you try to individually pick a name out, it needs to be on news or something, right? That something that has a reason to be making it move. Y'all be careful, be safe. I will see you Friday morning. Next Wednesday, there won't be a morning briefing.